Okay, so very good morning. Welcome to the rundown then for Friday the 1st of July. So fresh start on a new month and a new quarter. Quite a few things to get through from a news perspective, which I want to take a bit of a closer look at today. And then we can look at the kind of broader outlook for the session as a whole. So starting off with the politics first. And obviously yesterday was the papers have been reporting it as equivalent of Game of Thrones or the House of Cards, because political in-house fighting has escalated to a new level, which culminated in Boris Johnson then pulling out of his potential race to become Prime Minister. The chap in the middle played the role of Sirius Snake and stabbed his partner in crime from his school days, proverbially in the back. I think it was an untenable position that Boris was then put in, given that he was very much called out by Michael Gove. Don't forget, these are two which campaigned heavily together in a build-up of the Leave campaign. And then right at the 11th hour, Gove basically says that Boris is unfit to run the country. Boris then surprised and then pulled out of the race. That's pretty much then opened up Theresa May as a shoo-in at this point. What I'm sharing with you here are the bookies' odds. I do stress, believe the bookies' odds at your peril. We all know what happened with the 90% probability they were suggesting for a Remain victory in the EU referendum. But I think this does make logical sense. Theresa May played it quite well in terms of staying out of really the limelight during the campaign few weeks and months, and therefore she hasn't really been tarnished by strongly pinning her flag to one side or the other. So in general terms, she should be able to draw a consensus within the party. I think with Boris out of the way, then that's pretty much the way it's going to go at this point. Quite a few articles this morning from a markets perspective then talking about the fact that Boris is gone. There were always a lot of question marks about Boris actually being very pro-EU in many sense of the word. And so now that Theresa May is likely to come into play, probably it's going to be harder now for us to backtrack on actually trying to renegotiate staying in the EU. They may now draw more of a harder line, given that they are on the Leave stance. So that's something to watch. Obviously, this is important, not really for the intraday, but more so because we need to have a kind of an internal leadership runoff to then identify out of the 5, narrowed down to 2, and then of the 2 we choose then who we want to become Prime Minister. And this process will likely take us through all the way to the beginning of September, ahead of the next Tory conference held in October. So any triggering of this Article 50 to get negotiations underway with the EU, likely not to happen until after that, possibly not until the end of the year. Some quite important news that we saw yesterday though. I'm looking here top left at the British pound, and in particular this sell-off here. Now, don't be fooled, this was actually a pretty aggressive sell-off. I mean, from even on that one candle, this is an hour candlestick, 134.33 down to 32.45. That's a pretty big move by normal standards. It's just that these size of moves have become quite a common occurrence in the last week since the referendum result. So why did that happen? Well, you had Mark Carney give a speech yesterday and essentially gave a very strong hint that the Bank of England are preparing to unleash another round of monetary stimulus. To quote his own words, he said that the country was suffering from economic post-traumatic stress disorder. I think that's a pretty strong worded way of looking at it. But he went on to say they would take whatever action is needed to support growth. Now, for any of you that have been in the markets for long enough, that rings very familiar alarm bells in my head of what Draghi said during the height of the European sovereign crisis, of which ultimately verbal intervention from Draghi actually saved the day at that point in time. And it feels very much like Carney's trying to do a similar thing. Now, when he did come out and make that commitment that we're going to see a lot of stimulus, the pound instantly started to sell off. The question marks that I would have, though, is that by using such strong language, are you, in effect, firing your bullets a bit early in the game? How are you actually... we haven't really had time to assess the damage that the economy may have had on the back of the Brexit, and already you're making such strong hints of further easing. To me, seems a little bit premature. So, that's going to be an interesting one to see how that played out. But again, that came pretty late in the day and did show the impact of the news. On that regard, I want to bring into play this research note that I've read this morning from HSBC. So this is a chart of the 2-year SONIA curve, which is the effective reference overnight rate for unsecured transactions in the sterling market. So essentially, you can just call it, if you like, the rate, a measurement of interest rate in overnight markets in terms of lendings between banks. And you can see it's dropped dramatically most recently. So the market certainly is expecting more easing to come from the Bank of England. Just seeing though just so you're aware, while I'm doing the briefing, I'm just seeing a snap comment: ECB not currently debating abandoning capital key for QE buys. Keep an eye on bunds here. This should be bund positive and should be euro positive. Actually, just seeing the euro strengthen here and the bunds moved up to fresh session highs, reversing overnight losses. As ECB not currently debating abandoning capital key in QE buys, according to a source on Reuters. Seeing instant euro strength on the back of that as I'm talking now. Again, this is important because the Bund got absolutely killed last night on the original sources that said they were thinking about that exact option. The latest sources saying they're not currently debating that. Euro strength just going through in the FX market on the back of that. Actually, let's just bring up the euro so you can see what I'm talking about here. Here you go, that comment just dropped. You've just seen a move from 111.20 all the way up to 111.40. So a good 20 pip move there on the back of that. This may well be further supportive, so just keep an eye on the euro. Just while we're on this subject, this is really why you've got to be up to speed with catching up with the news. That actual source comment originally dropped after 5 o'clock last night. So this is why you need to do your preparation of where the market is placed, why the market moved like it did last night, so that when you hear comments like that from a news perspective, you're able to action a decision much quicker. So again, the euro's still on the upward trend here. Okay, just moving back though to this research note that I saw from HSBC. Obviously here the point I'm making is that the market's already begun to price in the prospect of more easing. Now, a very interesting thing here is going to be the timing in which the Bank of England might look to act. Now, there was a chart here, if you just bear with me. Well, we can look at here. The point being is the timeline. Now, looking at the timeline of the economic data coming out of the UK during the month of July, it's all data measuring predominantly May, and then also a lot of it is factored in from the survey period for early parts of July, or early parts of June, excuse me. So the data we're going to see in the UK this month, the month of July, actually doesn't take into account the referendum and the impact of the referendum. So if you're looking at economic data from a UK perspective to gauge then what or the severity of the downturn we could be seeing, which obviously then is going to impact your view on how much to sell, or if not sell the pound sterling, then you're going to have to wait till August before we can really assess the damage that the economy is going to come under in the wake of the EU referendum. That being said then, if we're waiting till August, that's really important because of this reason right here, the 4th of August. That's because that's when the Bank of England have their next quarterly inflation report. Now the BOE works very similar to the Fed. As you know, the most important and likely times that the Fed will move interest rates is when they release their quarterly projections and Janet Yellen gets to speak in a press conference. So the Bank of England follow exactly the same process. They have what they call the quarterly inflation report, where they'll release their 2-year horizon for CPI and GDP, and that basically gives the market a forward-looking expectation of their interest rate path over the forthcoming period. That's also then when they get to follow up with a full press conference with Carney. That's why most of the investment banks now on the street are expecting a Bank of England move in August. That would be the most opportune time for them to act. And that's when they would have had enough data to assess the damage of the referendum. So hopefully that explains a kind of timing thing to look out for. As I'm speaking as well, let's just move this chart. Gold at session highs again. Just keep an eye on gold at these levels. I've already got this 1340 marked up at the moment. That was the kind of post, we spiked higher, obviously on the back of the surprise leave vote from the referendum. We pulled back. We then retested up at the reopening of electronic trade, that 1340 level, and that's contained the price action ever since. We're now back up to testing that. This almost coordinated effort from the likes of Carney and the ECB sources we saw yesterday is only going to help fuel further gains into spot gold. In fact then, this is probably an opportune time to show you this. This is Deutsche Bank's monthly performance, that's total return performance of major global financial assets in June of 2016. Look who the outperformers were. Gold and silver, and they took the biggest move only in the last week or so. Obviously this kind of shock event that we had with Brexit, that's heightened economic uncertainty, and that's prompted these central banks now to be looking at further ways in which they can help stimulate the economy. All of that is a net positive then for precious metals in a flight to quality. You can see here that rates also putting in a pretty decent performance. Gilt yields have been trading, UK bond yields at record lows as well. So again, gold on the front foot this morning. We're already trading up just shy of $20. I can almost hear Will DeLucy rubbing his hands in the background while I'm speaking. Taking a look at bunds then. Bunds, now this is a very important, this bottom left hand chart. Look at the shape of the bund over the course literally of last night, yesterday evening, probably when most of you were logging off, and then to where we are now. A complete reversal. But you guys who trade fixed income products, how long or how many times have you seen the bund move from 167.33 down to 165.51, almost 2 points in, this was actually about a half an hour period or 35-minute period. This was out of your main kind of time of the trading action when most traders are at their desks, and yet you had one of the biggest moves I've seen in a long, long time. So why did this happen? Let's quick look. I marked this up yesterday, so it's it's all ready to go if you like. Here's one I made earlier. So this was the news. And this goes to show the importance of being a trader. If you're going to react to news, it can happen at any time. 5 o'clock, most of you I know were packing up for the day, and I was too. But then I heard the squawk, I heard the words ECB sources, my ears pricked up, then I heard the fact that they were talking about loosening QE requirements as Brexit has depleted its asset pool, and ECB options include moving away from the QE capital key. Instantly to me, that is a massive negative for the bund. Now to explain that, as bunds have been moving higher and higher and higher, or as the likes of gilts and treasuries, essentially, as we've seen, a lot of global yields are falling further and further into negative territory. There is an effect, according to the ECB's plan of how they buy bonds, a line in the sand of which when a yield goes so far negative, it is no longer eligible for them to buy. That means their universe of assets to buy is dwindling. But what they effectively came out and said yesterday, or an ECB source said, was that they were thinking about loosening the requirements, i.e. moving away from capital key, and also the ability to possibly open up the number of assets they can buy. Now, if that was the case, that would be to the detriment of the Bund futures specifically, because then it means they can turn back to the likes of Italian, Spanish paper, which at the moment they find very difficult to buy because of where the yields are sitting. That will then open up more other assets, so otherwise reducing demand to buy specifically Bund futures. Now, the interesting thing here was the timing, because most European traders have probably already gone home for the day. So this was up to the US markets to trade it. And if you knew your monetary policy inside out from the ECB, you had plenty of time to get on that move. There was an initial very small blip higher on the fast money move, and then there was a huge push lower, because I think a lot of people were kind of confused on how to interpret that kind of comment. You know, this is why it's really important to understand these central banking policies. I know they're complex, but this is what's going to help you make these trading opportunities from a news perspective. Then this also lined up very well technically, because we sold off, we hit S1, we immediately bounced up to pivot, it then hit pivot, went back down to S2, it then came back to pivot, then it went back through. So the fundamentals eventually won out, and the Bund had a huge move to the downside, but on the way there was some excellent kind of technical levels there, using the various pivot, support 1 and 2, even R1 came into play. This was a real opportunity, and the point being is that when you're a trader, you've got to be prepared that anything can happen at any time. And if things start moving, then it's all guns blazing, and you're back on it for as long as it takes to see the move to its conclusion. The interesting thing then, this was Bunds last night, obviously. And you've seen Bunds get absolutely killed on the back of that, but look where Bunds are trading this morning. So this is my Bund chart here. We've completely reversed it. Now, remember that source comment we just heard a short while ago was that the ECB has said to not debate abandoning capital key and QE buys, and that's a really critical comment, which basically says the opposite of what we heard last night. Full retracement, back to, no surprise, pre-announced levels. So this is when you're looking at technicals and fundamentals working in harmony. Okay, just to wrap things up, people have been asking me about statistically July 1st, how does the land lies on that perspective? Well, let me just share with you this. So, July 1st is one of the best days of the year for the S&P 500, up 70.2% of the time. And that's looking at all the way back to the kind of dated back to the 1950s. Now, even though July 1st, 70% of the time over a statistically long period of time has been up 7 out of 10 times, you should not use that solely as a signal to buy the S&P. That is ridiculous thinking. Statistics are only there to provide you with more confirmation of a bias that you may have. It's something to be aware of. It is certainly not something I would choose alone as a single indicator to make me choose to buy. Any statistics must be taken in context of the current economic environment. So, just keep that in mind. This type of information is something that I use as another string to my bow to make an assessment of how the current economic sentiment is placed. I do not use it as a one-off key indicator to just simply buy. Important fact. And just wrapping things up, we did have some Chinese data overnight. The Chinese Kaizen manufacturing PMI, you can see here from the chart, we had the fourth consecutive move lower from the peak that we saw back in March of 2016. Keep in mind though, this is, I think it was the, let me just check, it's the lowest reading of 4 months and signifies the 16th consecutive month in contraction, i.e. below 50. I don't think this is wholly surprising. I don't think it's anything to really shock the markets, but we did hear those comments just this week about the fact that they're open to seeing further devaluation of their currency. If that happens to a large degree and the Chinese economy starts to slow in economic indicators, then this gets very interesting, because then you've got a Brexit crisis in Europe ramped up by extra stimulus from Western central banks, and if you throw Chinese volatility back into the mix like we saw at the beginning of 2016, then all of a sudden you've got a very interesting cocktail of facts that may cause some high volatility in these markets once again. Quick look at the calendar. You've had some of the manufacturing PMIs early this morning. Nothing too substantial. These are final readings, I believe. The Spanish reading 52.2, slightly higher than expected. The French reading 48.3, slightly higher than expected. You got the UK number that's coming out, but again, these would be pre-referendum. You've got this ISM manufacturing PMI from the US that will be interesting. But overall, even though Fed's Bullard spoke last night, he is still anticipating one interest rate hike. Personally, I think he's crazy. You're not going to see a US rate hike this year, I don't think now for sure. Not with the uncertainty taking place now in UK and Europe, and then with the US elections later this year. Speaker-wise, to be aware, you've got ECB's Weidmann speaking in Munich. That'll be at 4 p.m. Maybe something to just keep an eye on. He is the most hawkish member, particularly with this latest source commentary around potentially broadening the QE program. He would be the most anti to that happening. And then you've got Fed's Mester, who is a voter as well, speaking later on. Okay, so that's your briefing for this morning. Enjoy your trading session. I'll be on Hotcom throughout. Have a good day.